Do you want to know an investment strategy that has won for about 100 years? Do you want to understand two strategies that alternate superiority across market cycles? Do you want to find the investment method that fits your personality? The answer is simple. Compare value investing and growth investing. Look at the data from the past 100 years. Why does it work? This slide explains it all. For the past 100 years, value investing has recorded an annual return of about 12%. Growth investing is about 11%. The difference is just about 1%. But what does this 1% mean? Assume you invest $10,000 for 100 years. At 12% annually, that becomes about $190 million. At 11% annually, about $65 million. The difference is about $125 million. A 1% difference creates about 3 times the wealth through compounding. This is a trend observed in about 100 years of market data. But here's the critical fact. This is not a guaranteed law that will continue into the future. Depending on the period, long-term underperformance can occur. And this is a choice. Understand your personality. Do you have the patience to find undervalued stocks? Do you have the courage to bet on the future of growth companies? This determines your investment strategy. Today, I'll show you the scientific evidence. What is value investing? It's a strategy that exploits market errors. Benjamin Graham, Warren Buffett's mentor, established it. The basic principle is simple. Calculate a company's intrinsic value. Compare it to the market price. If significantly undervalued, buy. Wait until the market recognizes its error. Graham provided specific guidelines for defensive investors. P/E ratio of 15 or below. P/B ratio of 1.5 or below. Or P/E times P/B of 22.5 or below. This is the mixed coefficient. For example, a company's annual profit is $100 million. If market cap is $1 billion, the P/E is 10. Below the guideline of 15. Potentially undervalued. Value investors believe this. As Graham's famous metaphor states, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Emotions move stock prices, but ultimately they converge to value. Waiting for that convergence is the essence of value investing. However, there's a caveat. In recent years, corporate value has shifted to intangible assets, brands, and technology. Some argue that traditional metrics like P/B can't measure undervaluation anymore. The gap between accounting book value and actual enterprise value is widening. Growth investing is the opposite of value. Peter Lynch, manager of the Fidelity Magellan Fund, advocated it. During his tenure from 1977 to 1990, he reportedly recorded returns of about 29% annually. That secret is growth investing. The basic principle is clear. Find companies with profit growth of 20% to 25% or more annually. Invest not in current profits but in future profits. Here's where the PEG ratio becomes critical. It's the P/E divided by the growth rate. For example, if P/E is 30 and profit growth rate is 30%, PED is 1. Lynch preferred PEG of 1 or below. This isn't simply buying high P/E stocks. It's rigorously judging whether the price is reasonable relative to growth. Be cautious of revenue growth without profits or stocks that are too expensive. Growth investors believe this. Companies that will dominate the future look expensive today. But in 5 years, 10 years, they'll prove to have been cheap. Betting on that future is the essence of growth investing. In the 1990s, companies riding the internet revolution wave, Microsoft, Cisco, Amazon, all were called overpriced at the time. But growth investors won big. Now let's look at the 100-year track record. This is data from sources like the Kenneth French Data Library. From 1926 to 2023, about 98 years. One of the most reliable long-term data sets. Value stocks, annual return, about 12%. Growth stocks, annual return, about 11%. The difference is just about 1%. You might think only 1%? But don't forget the power of compounding. Assume you invest $10,000 for 100 years. At 12% annually, that becomes about $190 million. At 11% annually, about $65 million. The difference is about $125 million. A 1% difference creates about 3 times the wealth. This is the magic of compounding. But here's the critical caveat. These numbers vary depending on definitions and measurement methods. The definition of value isn't just PB. There's book to market, combinations of multiple metrics. Depending on which definition and which index you use, the appearance of value being strong or weak changes. Also, the difference is particularly pronounced in small-cap value stocks. In large-cap comparisons, the difference can narrow or reverse during certain periods. And here's the most critical fact. This superiority is not guaranteed to continue into the future. This is a trend observed in the past, not an established law. Depending on the period, long-term underperformance can occur. Market cycles determine superiority. Let's look at concrete examples. The 1990s, the technology boom era. Growth stocks dominated. Microsoft, Cisco, Amazon surged. The IT bubble formation period. But in the 2000s, the IT bubble burst. Now value stocks dominated. Growth stocks struggled, and value made a comeback. In the 2010s, growth dominated again. The rise of FAANG, the reevaluation of technology companies. Amazon, Apple, Netflix, Alphabet, Facebook drove the market. And from 2023 to 2024, driven by AI revolution expectations, growth stocks are once again significantly outperforming value stocks. The S&P 500 Growth Index returned over 30%. The Value Index returned a few percent to about 10%. The impact of the Magnificent Seven. Do you see the pattern? When the market environment changes, superiority reverses. Low interest rate eras theoretically tend to favor growth. High interest rate eras theoretically tend to favor value. However, the economy, inflation, and corporate earnings also have major impacts. It's not simple. Technology innovation periods favor growth. Economic stagnation periods favor value. Which market environment your investment period hits? No one can predict that. Numbers aren't the only issue. Psychology determines success. The psychological trial of value investing is patience. You buy undervalued stocks, but the market doesn't immediately acknowledge its error. You wait 1 year. It keeps falling. You wait 2 years. It still doesn't rise. You wait 3 years. Finally, it reverses. During that time, you keep doubting. Was my analysis wrong? Will this stock remain undervalued forever? Can you endure this doubt? The psychological trial of growth investing is volatility. You buy high-growth stocks. PE is 50. Expensive. But if growth continues, it's justified. Then one day, earnings announcement. Growth rate falls short of expectations. As a hypothetical example, high PE growth stocks can move by tens of percent in a single day on earnings. Your $10,000 becomes $7,000. Can you endure this crash? Should I sell? Should I buy more? Can you make this decision calmly? Both strategies are battles with emotion. If you choose a strategy that doesn't fit your personality, you'll sell at the worst timing. You won't be able to buy at the best timing. Result, you lose even to market average. So which should you choose? Actually, it's not a complete binary choice. There's a way to blend both. For example, 60% value, 40% growth. 60% of your portfolio in undervalued stocks, 40% in growth stocks. What does this allocation bring? Value stocks provide stable returns. Growth stocks capture major growth opportunities. In any phase of the market cycle, one of them works. Or 50% to 50% is also fine. A completely neutral allocation. There's also the example of rebalancing once a year. If growth stocks surge significantly, sell some. Buy more value stocks, and vice versa. This way, you leverage the strengths of both. You can also diversify risk. However, here's the critical caveat. Allocation and rebalancing frequency are just examples. Design according to your investment objectives, risk tolerance, tax costs, and transaction costs. And you should decide your core axis that fits your personality. If 60% to 40%, the 60% should reflect your essence. If 50% to 50%, that itself is your philosophy. Not a completely mechanical allocation, but one that reflects your convictions. That's the key to long-term continuation. Now, let's organize today's critical points. Here's today's summary. First, the trend observed in long-term data. Value investing has been observed to return about 12% annually over the past 98 years, growth investing about 11%. A 1% difference can create about 3 times the wealth through compounding. However, this varies by definition and index and doesn't guarantee the future. Second, market cycle fluctuations. The 1990s favored growth, the 2000s favored value, and from 2023 to 2024, driven by the AI revolution, growth is once again significantly dominating. Which market environment your investment period hits, no one can predict that. Third, personality compatibility. Value investing tests patience. Growth investing requires courage to endure volatility. If you choose a strategy that doesn't fit your personality, you'll fail emotionally. A 60% to 40% blend is also an option, but design the allocation according to your objectives and risk tolerance. Which will you choose? Or will you blend both? Share your strategy in the comments. Your investment philosophy, your experience, your questions, all of it becomes this community's wisdom. Thanks for investing your time with me today. This channel breaks down value investing, growth investing, and every wealth-building strategy with numbers. You can achieve financial freedom too. If you want to gain that confidence, subscribe to the channel. Turn on notifications too. Until next time, keep building.